This is the Chapter 16 workbook presentation on inventory video. Chapter 16 is a foundational chapter, and it's a pretty important chapter because it deals with the concept of inventory. And one of the reasons it's pretty important is that we're going to be dealing with inventory and the way of inventory costing, movement, measurement, etc. over the next probably 3 to 4 chapters. So what you want to do is you want to learn the foundations here in chapter 16. And you don't want to try to attempt to learn them by applying them, the basic foundations, with more of the complex concepts in future chapters. So that being said, inventory is a large portion of managerial accounting, and the reason for that is that if you take a look at the components of a balance sheet in the assets section, in other words, the things that are of value to a business, one of the major, either the largest or one of the largest items on the balance sheet for a merchandising or a manufacturing company is that of inventory. And inventory is a fairly complex process in terms of how we actually measure the cost of inventory and how we measure the movement of inventory within a manufacturing company. And also, when the inventory is sold, the cost of the inventory directly impacts the cost of goods sold for the inventory, which is a major, if not probably the biggest component on a manufacturing or a manufacturing or a merchandising company's income statement. So with that, let's take a look at a couple of definitions. Now we're going to talk about the concept of what we call a merchandising company and also a manufacturing company. These are both the two types of companies that would measure very material amounts of inventory and also have a very significant amount of cost of goods sold on the income statement. Now, a merchandising company is pretty easy in terms of the concept. It's a company that sells products to the public with the goal of earning a profit. Now, a merchandising company does not normally manufacture the product. The merchandising company typically purchases a product from a manufacturer or a distributor and then sells that product to other businesses or to the public, again, to earn a profit. And probably some of the most recognizable names would be Walmart or the famous French store Target or Amazon. All of these particular organizations purchase products from somebody else, and then they go ahead and sell those products in either their retail bricks and mortar locations or their online presences. Now, it's true that Walmart and Target and Amazon have some products that are under their own name, but they normally don't manufacture those products. Those products are made by a third-party manufacturing entity, and as an example, Walmart then will make sure that it's branded as Walmart, so it appears to be a Walmart product, and it is a Walmart product, but it is being manufactured by somebody else. Now, the other type of company we're talking about is what we call a manufacturing company, and it's a company that, and here's the important thing, makes products. It actually makes the products and then sells the products typically to distributors or to the public themselves, with the goal, of course, of earning a profit. And I've listed 3 types of manufacturing companies, and that includes Apple Computer. Apple Computer normally manufactures its computers and its iPhones and other products with the goal of selling these products to distributors and who will sell them on to the public. Now, Apple does have some what we call company brand stores, but again, overall, they're relatively they're a minor presence compared to the presence of iPhones in normal retailers. Now, another company that may be familiar to you is Tesla Motor. And Tesla is making a limited amount of electric cars. And so Tesla actually manufactures those electric cars. Now, Tesla is a little different in that because Tesla's operating philosophy differs from other, as an example, large car companies, Tesla actually owns all of the distributors who basically sell Tesla cars to the public. And the reason they want to do that is to maintain their product image and also their quality process. So Tesla basically is a manufacturing company that it also distributes all their products. Now, you can compare this to another car company such as General Motors. General Motors actually manufactures the cars, the products themselves, but then those products are in effect sold on to distributors, or if you will, dealerships in the different states, and the General Motors brands are distributed through those dealerships. Same thing with Ford, and same thing with today's Chrysler. The third organization that I mentioned in terms of manufacturing companies is Intel, whose major business is producing computer chips for various types of computers, mainly mainly PCs. But they're basically their major product is Intel, or sorry, the computer chips. And again, typically they normally don't sell a lot of chips to the public. They sell these chips to other computer manufacturers. So Intel basically makes products and it sells this to, in effect, other manufacturers to go into their computers, or other organizations that utilize the Intel chips for whatever type of device they're using it for. Now we're going to go into some more definitions. And when we talk about a company with a major amount of inventory, we always want to talk about what makes up the cost of that inventory. So we're going to start talking about the different costs basically that make up the cost of inventory in a company. And all the items that are part of inventory cost we call product costs. Now, product costs are the costs that are associated with the manufacturing of a product. And in effect, those costs will become part of the product inventory cost as it goes through raw materials, work in process, and finished goods. And we'll talk about that just a little while. Now, there's several different categories of direct cost. And a direct cost is a costs that are directly associated with manufacturing the product. So again, costs that are directly associated with manufacturing the product. And that is made up of two major categories. The first one is being direct materials, direct materials. And that means these are the materials that are actually incorporated into the product itself. So these are the materials that actually become part of the product. Now, an example, there's many different examples. I'm just using a real simple example down here of a company that makes candles. Examples of direct materials would be the wax for the candle wick. The color of the candle is going to be the scent, and then if there's a base for the candle and so forth. I'm sure there's other components that go in, but if we want to take a really simple view of this, a candle maker, these would be some of the major direct materials that are incorporated into the product itself. Now, in addition to direct materials, there's direct labor. And direct labor is the labor or the labor cost that is directly involved in manufacturing the product. In other words, the people who actually are making the product or assembling the product in either an assembly line or other type of production process. And examples of this would be production labor, the people on the factory floor, the production floor, actually putting together their products, assembly line labor, fabricators, painters, all these people who actually add value directly to the product itself. Okay, now those are direct product costs, and that's part of those are direct product costs, part of our product costs. We also have another major component. We call these indirect manufacturing costs. So the first group was direct. These are indirect. Production costs that are basically indirect manufacturing costs are production costs that are incurred indirectly, but these production costs or these activities and the costs associated with them are essential to the manufacture of that particular product. In other words, if for some reason we didn't incur those costs, the production process itself would probably stop, or the efficiency would be diminished considerably. Now, the first type of an indirect manufacturing cost is what we call an indirect material. And an indirect material is the cost associated with that material where it's used in the production process, within the process, but that material is not incorporated into the product itself. So it's used in the production process, but that material never finds its way into the product itself. Some examples, such as lubrication for production machines. So if you have automated machines on the production floor, they are actually creating their own products, or creating, whatever they've been built to manufacture. And in order to keep those machines running, they have to be lubricated, oiled, all sorts of ongoing maintenance to make sure the machines are working correctly, and also to make sure that the machines won't seize up and just basically break down. So that'd be an example of an indirect material. Another type of indirect material is where a company is making products from molds. And those molds may have a useful life of maybe 10 material injections, and then they have to change to another mold and so forth, because the old one starts wearing out. So molds would be another example of an indirect material, because it really doesn't become part of the product itself. Also, stenciling, items that are used to tools or contact type of paper, things like that is used for stenciling maybe, or painting products. Again, as those are used, they tend to wear out as part of the production process. Now, in addition to indirect materials, we have another item called indirect labor. And indirect labor is basically the labor that is associated with the labor costs that are incurred indirectly with the manufacture of a product. Now I have several examples regarding indirect labor. As an example, supervisors. Supervisors don't work directly on the product, so they're not direct labor, but they are in charge of the organization of the production or the assembly process, and they keep it operating efficiently and effectively. So this is indirect labor, because without the supervisors, there'd be kind of like chaos on the production floor. And so without the supervisors, we would lose, either production would stop, or we would lose considerable efficiency. Also, another group would be inspection labor, people who are inspecting the production process to make sure that the items that are being produced are within specifications, to make sure that when something is produced and goes out the door, it meets the specifications of the manufacturer. Also, safety inspectors, people who go throughout the plant and make sure that the workforce is safe and there's no dangerous conditions that may exist. These are all examples of they support production, but they're not directly involved in production. Another section then in indirect cost are what we call other indirect manufacturing costs. And these are materials and other production related costs that are incurred indirectly with the manufacture of a product. And again, if these costs for some reason are not incurred, what would happen is that would adversely impact the production process or stop the production process. And some examples could be such as utilities. Let's assume that we're working in North Dakota and we have a manufacturing facility. If you didn't have that facility heated, it would probably be impossible for the workforce to actually function effectively and efficiently in an environment where everything was pretty much freezing. So it doesn't, these utilities aren't incorporated directly into the product. And on the other hand, they're not part of an indirect, so if they're indirect, they're not an indirect material because the utility is more of a service, and they're not indirect labor either. So these would fit under indirect other. And the same concept for depreciation. Okay, now let's kind of go over a summary in terms of product costs. Okay, product costs are the cost of making a product, manufacturing a product, and all of the cost in terms of manufacturing a product are going to be included in inventory cost. So when we develop our inventory cost, we're going to have to ensure that we include our product costs, which include direct materials, direct labor, and indirect cost. And remember, of course, of the indirect costs, there are three categories, which would be indirect materials, indirect labor, and indirect other. So these are production costs that become part of inventory. Now let's move on to another type of cost within a manufacturing company, and I call this non-inventory related cost in a manufacturing company. Non-inventory costs are also, and mostly they're referred to as what we call period costs. Period costs are the entities, activities / cost that these activities are not involved at all in producing the product, but they're essential to the function of the company as a whole. So in other words, the accounting department is not involved either directly or indirectly in terms of the manufacturing process, but the accounting department is going to be essential to the operation of the entire company. These type of costs are called, again, period costs, and period costs are expensed as they are actually incurred. What we'll find out with this is product costs. Product costs move with inventory movement. Period costs are simply expensed as incurred. There's two types of major period costs. The first one being sales and marketing costs. And the typical sales and marketing costs would include costs associated with storing goods, warehousing if you will, transportation and delivery of goods, marketing and selling costs associated with selling the product, and other related type of cost. Another type of period costs are what we call administrative cost, and these are all other costs that are essential to the function of the business that are not selling costs that we have up here, and basically in product costs. And that would include like executives, administration, human resources, accounting, legal, and other generalized types of activities. So these would be called period costs, and these costs again are expensed as they're incurred, whereas product costs move with the movement of inventory throughout the process, and then when the product is sold, they move from inventory to cost of goods sold. Now let's take a look at the cost flow in a manufacturing company, and the first thing we want to make a point is that inventory costs, the costs themselves, follow the physical flow of inventory in the company. And what we're going to see basically is that the inventory before it's sold sits on the balance sheet. When the inventory is sold, then the cost of the inventory moves to the income statement. And this is also how the physical flow of the inventory moves. Now let's take a look at what happens. Okay, the first thing we're going to start out with is the inventory we call direct materials. In other words, the inventory, the materials that are going to be used directly in the product. We buy those materials and typically hold them in inventory so they can be pulled out of inventory and transferred to the production floor when we're ready to start production on whatever items we're going to be producing. So we start out with raw materials, and that goes under raw materials inventory on the balance sheet. Now, I've also used the word direct materials to describe raw material. Now at some point in time there's going to be a demand for products, and the raw materials are going to be removed out of the raw materials inventory and moved to the production floor. Now those raw materials are ready to be worked on. Those raw materials, then we're going to have our direct labor, the people who are involved in direct labor, work on those materials, and also on the production floor we're going to incur indirect production costs, and that would include indirect materials, indirect labor, and indirect overhead. So we take our raw materials and we apply our direct labor and our indirect efforts towards the production, which means direct labor cost and indirect cost. And those items, while they're being worked on the shop floor or factory floor, whatever you want to call it, are called work in process, and they're also part of the balance sheet. But you'll notice physically we've moved our raw material into work in process, and we've applied labor and overhead to it. Now, when that work in process is completed, whether it be all the work in process or part of the work in process, those items are transferred basically to what we call finished goods, because now they're completed. So what happens is that the value of the work in process is now transferred for those items that are completed into finished goods. Finished goods stay in finished goods until they're actually sold, and then the actual physical goods move out of the company to the customer. And from an accounting point of view, the cost of those finished goods transfers from finished goods on the balance sheet to cost of sales or cost of goods sold on the income statement. So what you can see here is basically the physical flow of the materials with labor and overhead added to it, then flows through to finished goods, and then when it's sold, through to cost of goods sold. And that's exactly the same way the costs flow. So now let's take a look at some summary items just from what we've learned in this diagram. Okay, number one, product costs are accumulated as inventory cost on the balance sheet. Raw materials, work in process, and finished goods. Number two, inventory costs follow the physical unit through the production process, as we illustrated above, and we see the cost following the physical unit through the production process. And as I say here, from raw materials to work in process to finished goods. Lastly, inventory costs are transferred from finished goods to cost of goods sold on the income statement when the inventory item is sold. So when the item is sold, it's the cost is transferred from the balance sheet to the income statement as a cost of goods sold. Okay, now we have an exercise in terms of classifying different types of costs, whether they're a product cost, and if they're a product cost, are they direct material, direct labor, indirect cost material, indirect cost labor, indirect cost other, or are they a period cost? And if they're a period cost, are they selling or admin? So let's go ahead and try this. Now, before I do this, it would be helpful from your own understanding point of view, if you'd stop the video, go through each of these particular items and make your own choices. After you've done doing that, go ahead and restart the video and we'll go through the choices. Okay, restarting the video. The first thing we look at is wages of factory supervisors. Okay, we know factory supervisors are somehow involved in the production. And so we know it's going to be a product cost, but is it direct or is it indirect? Well, remember from our presentation, the factory supervisors don't really work directly on the production itself, so they're going to be an indirect cost. And here we have material, labor, or other, and it makes sense this would be product cost, indirect labor. Okay, lubricating oil for production machines. Again, this looks like a production cost, but is it direct or indirect? Well, if we do a little analysis, we know the lubricating oil isn't used directly within the production process. It's used on a machine that creates our production. So we would say that this is some type of material and it's an indirect. So it'd be product cost, basically indirect material. Okay, the next item is wages of employee installing leather on car seat in an auto manufacturing company. So the employee is basically installing some leather on a car seat. Well, in this case, the employee will be wages plus, since the employee is actually working on the product, it would be product cost, direct labor. Okay, the next item, wages of factory security guards. Okay, now again, we're saying the word factory, so that means that is the facility for which production is basically occurring, which means, okay, the factory guards aren't directly involved in the product, so probably wouldn't be, it wouldn't be direct material, direct labor. However, the factory is part of making, it houses a production facility, so it is a product cost. But in this case, it would be an indirect cost, and since these are wages, it would probably be product cost, labor, indirect product cost, indirect cost, labor. Accounting department salaries. Accounting has nothing to do with making the product, so we know it would be a period cost, and we'd have to pick whether it's selling or admin. In this case, it would be admin. Okay, the next one would be factory heating, and this is heating of the production facility, so it is some form of product cost. However, we know the heating really isn't isn't applied in the production process. It basically allows labor and the whole process to be more effective and efficient. So it's an indirect cost, but it's not really indirect material, nor is it labor. It would be indirect other cost. That's the best fit for it. Okay, the next one would be office building electricity. In office building electricity, we do know electricity is some type of utility, and we'd said before, well, utilities are part of a product cost, and that's when it is part of the factory. In this case, it's our office building. So our office building is going to house probably our selling and administrative costs. And the cost for the electricity in the office building would most likely be the period cost under administration. So that is a representation of what would be the correct answers for this group of questions. Now we're going to do the same thing one more time with another set of circumstances. So what I would suggest you do is, once you get to the video here, go ahead, stop the video, and attempt to answer the questions on your own. And after you're done, go ahead, restart the video, and you can review the answers. Okay, the first one may be just a little tough. Company income taxes. Well, when we say this, these are income taxes that are paid for the whole company. Now, income taxes have nothing to do with production, so no product cost issue there. So it'd be a period cost, either selling or administration. And the most likely place for this cost to be classified would be under administration. Okay, flour used in a bakery. So we're using flour to make bread or to bake goods. And obviously that's a production cost, it's a product cost, and it is a direct material in the bakery. Factory Safety Inspection Department. Again, these are individuals who help facilitate production, but they're not directly involved in production. So they'd be a product cost, but an indirect product cost. And in this case, we have material, labor, or overhead. And since these are salaries, these would be indirect labor costs. The next item would be product delivery expenses. And again, delivery has nothing to do with the actual manufacturing of the product, so it's going to be a period cost. So it would either be selling or at admin, and the most likely here would be period cost selling expense. The next one would be depreciation on the office building. And since it is depreciation, it's something that is neither a material labor, it's some type of other, but it's depreciation on the office building. So in this case, it would most likely be a depreciation would be a period cost under admin. Now we have depreciation on the factory. In this case, again, since it would be the depreciation on the factory would be most likely, it wouldn't be a direct product cost because it's housing the production. So it would be an indirect product cost, and the question is, would it be material, labor, or other? It's most likely in this case it doesn't fit the definition of material or labor, so it would be an indirect cost, other. And that's the summary of the solutions to the product cost exercise. Okay, now we're going to go on to another really important concept. And this particular concept, it's really a simple concept, but you can make it can get very confusing. And the other thing is that not only is this concept simple, but it's very important. You're going to carry this concept in a couple of different ways throughout all the inventory illustrations, throughout all the chapters we're going to be going through in the managerial accounting course. Here's the concept. We start out with beginning inventory. Pretty easy. This is what we begin with. With our beginning inventory, then we put additional inputs into the inventory. In other words, additional stuff. I'll just use the word stuff for inventory. So we start out with stuff. Now we add more stuff to the inventory. Then we take stuff out of the inventory. In other words, outputs. Therefore, at the end of the day, we have an ending inventory. So we start out with beginning stuff, we add stuff, we take stuff out, and then we have an ending amount of stuff. I know that sounds pretty basic, but that's exactly what it is. So beginning inventory plus inputs minus outputs equals ending inventory. Now let's take a look at how that would work from a costing standpoint. Here on the left-hand side, we have this example. We have beginning inventory of $35,000. We added $25,000 worth of value to the beginning inventory, and also we took out during that same time period $40,000 worth of value. So it's a matter we take beginning inventory plus our inputs minus our outputs equals the ending inventory. So what does that come out to be? The $35,000 plus the $25,000, that equals $60,000 minus the $40,000, and that leaves us with an ending balance of $20,000. Pretty simple, pretty straightforward. And again, this formula, beginning plus inputs minus outputs equals ending inventory, you're going to see in many different forms, so it's best to remember this formula. Now let's try the next slide over here on the upper right hand corner. Now in this case, we have something a little different. We have beginning inventory, but there's no value there, so that's our unknown, that's X. We have our inputs, we have our outputs, and our ending inventory. So in effect, what we need to do is we need to solve for our beginning inventory. So what we want to do is we want to utilize whatever method that we want to regarding how do we solve, what is that X? Now what I'm going to do is I'm going to use a little shorthand algebra technique, and it's really, really simple. And I'm going to show you how to do it if you don't already know how to do it. I just turned this into an equation. Beginning inventory plus my inputs of 55,000 minus my outputs of 80,000 equals $25,000. So that's an equation. Now I can just use a little simple algebra, and I don't have to move things around. I don't like to move things around, but here's what I'm going to do. I'm going to pull out my trusty calculator. Unfortunately, my trusty calculator for some reason I can't shrink it down any further. So it's a really, really big calculator, so I'm going to have to kind of move it around. So what I'm going to do is just use algebra. I'm going to take the $25,000 to the right of my equal sign, and simply I put $25,000 here. Add that in. Okay, now what I'm going to do is to the left of the equal sign, all I'm going to need to do is reverse my signs. As an example, this says minus $80,000. So what I'm going to do now is I'm going to reverse that sign, and I'm going to say plus $80,000. Okay, and I add that in. Okay, now I go over to the $55,000. And in this case, it's a positive number. So in this case, I reverse the sign. I'm going to minus $55,000. So minus 55,000. And since now I've basically solved for my beginning inventory of $50,000. See if that's basically the bottom line, $50,000. So if I take my beginning inventory of $50,000, I add, oh, I'm sorry, I accidentally did that. That should be $50,000. Let me move that out there for a second and replace it with the $50,000 right here. So if I take my $50,000, I add in 55,000, that's 105,000. Subtract out 80, there's my ending inventory of 25,000. So I've solved that. Now, what I wanted to show you here is there's a number of different ways of doing that. I just showed you by simply reversing the signs, I could come up with the correct number. Now, what you could do also is, I'm going to move this out of here, subtract this out of here for a second, and assume that I really don't know how to do that. So I'm going to try another technique. Now here's another tried and true technique if you don't like algebra. What you do is you simply take one of these two numbers here, either the inputs or the outputs, and you plug that number into beginning inventory. So let's try that. I'm going to put 55,000 in there. Why? Because I can do that. Now let me just get this so it's a little bit better aligned. There's my 55,000. Now I do the math. So I'm going to take $55,000 plus 55,000, and I end up with $110,000 minus 80. That means the ending inventory balance that I'm computing based upon the 55,000 would be, in this case, let me write it down here, would be equal to 30,000. And what that's telling me is, well, with $55,000, see if I can change the color here for a second. With $55,000, my ending inventory shows I'd end up with $30,000 if I plug that into beginning inventory. So what that says is my ending inventory, actually it has to be 25, not 30,000. So all I need to do is say, well, all I'm going to have to do is reduce my beginning inventory down by 5,000 to 50,000. I come out correctly. So either way works just fine depending upon how you want to do it. Now let's try the lower left hand corner. And again, I'm doing this because you're going to find this technique is going to be used a lot over the next several chapters. So let's start out again. We have beginning inventory of $20,000, input X, output 65, ending inventory equals 30. So again, I'm going to use my handy dandy calculation where I basically write out the equation. Beginning inventory, or sorry, $20,000 of beginning inventory. My input is I don't know what it is, minus my output, which is 65,000 equals 30,000. So all I need to do then at this point is I start out again, go back with my calculator, my gigantic calculator here, clear it out. I'm going to start out with, I'm going to input the amount to the right of the equal sign, $30,000. Okay, now I take a look on the left-hand side and I see I have a minus 65,000. So that means what I want to do now is I want to add, in other words, change the sign to a plus 65. Whoops. So I'm going to take the $30,000 and I'm now going to add $65,000 to it. I need to add the 35 again. I had accidentally not added it. Okay, there's the 35 plus now the 65. Okay, there's a 65,000. Now I've double added it. Okay, let me start over again. I start out with the $30,000 on the right of the equal sign. I add that in. Now I'm going to add in the 65,000. And now that totals $95,000. Now I go over to the far left-hand side where it shows $20,000. Now there's no sign there, but we know it's a plus because it's positive. So in this case, I'm going to change that plus to a minus. So I'm going to subtract out $20,000. And again, you only see part. There's the 20,000. I just had the part of it in there. So I'm going to subtract out $20,000, and in the end then I end up with $75,000. Whoops, I'm having a problem with my calculator here. Okay, now it should come out 70, and there's $75,000. So if I take and replace this missing item with 75,000, I'm going to get 20 plus 75, that's 95. Minus 65 is going to equal $30,000. Okay, we can try this again on this bottom right-hand box. And in this case, my missing item is outputs. So again, I can write my equation. 10,000 plus 35,000 minus O, outputs, or the X, equals $5,000. So again, I can go back to my calculator and I can restart, set it over again. And with the amount now, I can start off with, I put in the amount to the right of the equal sign, 5,000. Let me make sure it's set up right, 5,000. So I'm adding that in. And then I go to the next item, the next value, and it's a plus 35,000. So I'm going to subtract out 35,000. Okay, then I'm going to add, then I just subtracted out 30,000. Then in addition to that, I have a 10,000, and that's a positive amount. There's no sign there, but it is a positive amount, so it's 10,000. So I'm going to then change that positive to a negative sign, and that's going to be another minus 10,000. I do that, and I come up with a minus $40,000. And now if you take a look at this, the answer would be the minus 40,000. And you see here 10,000 plus 35 is 45 minus the outputs of 40,000 equals ending inventory of $5,000. So again, I'll give you this proposition that this process is deceptively simple, but you've got to get comfortable with it because you're going to be running into it a lot of times over the next several chapters. And sometimes it will not be quite as apparent as this. Okay, now let's take a look at, rather than calling it inventory flow, we're going to call it, well, this is inventory flow throughout the balance sheet, but we're not going to deal with any numbers at this point. We're just going to deal with the concept of inventory flow, how inventory flows through the raw materials, the work in process, and the finished goods inventory accounts. So again, now we're starting out with the concept. We have beginning inventory, then we have an add, then less, then equals under raw materials inventory. Now doesn't that sound familiar? Beginning inventory plus inputs minus outputs equals ending inventory. Same thing. Beginning inventory, add inputs minus outputs equals ending inventory. Now let's take a look and watch how this works. I start out with my beginning inventory, then during the period I'm going to purchase raw materials into my inventory account. So I'm going to add the value of those materials to the inventory I already have. I add them. Okay, then the next item then is I'm going to be taking items out of my raw materials and adding them to my work in process as I start production. So this would be less raw materials transferred into work in process. That will equal then at the end of the day, that will equal my ending raw material inventory. Beginning inventory, add purchases of raw materials minus raw materials transferred into work in process equals my ending raw material inventory. Now let's take a look at how that movement now occurs in work in process. I have my beginning inventory, which is whatever inventory I started out with. To that then I'm going to add my raw materials that I transferred in from the raw materials that I've transferred in. And that would represent the raw materials that came from here up into the raw materials that I've transferred in. To that then, I'm going to add the direct labor that I'm using to work on those materials and also the indirect costs. So those items now have been added in. Now let's move on to the output. I'm going to transfer any work in process that I've completed. I'm going to transfer the value of that work in process to finished goods. So again, beginning inventory plus my inputs minus my outputs equals my ending work in process inventory. Now we go on to finished goods inventory, and again I start out with whatever beginning inventory I've had. Then I'm going to add the work in process that I'd completed from my work in process inventory, and now I've transferred it to finished goods. And again, if you take a look here, the work in process being transferred into finished goods. Okay, then I'm also going to be selling finished goods inventory, so that'll be the value of my finished goods sold, and the cost then of those finished goods are transferred to cost of goods sold. And what you'll see again for finished goods inventory, we have beginning inventory, the inputs we have beginning inventory, finished goods, then the inputs into finished goods inventory, less the outputs, the items moved out of finished goods inventory and then were sold, equals basically our ending finished goods inventory. Now what you can see here is when I'm transferring my work in process amount out of finished goods and to the customer, we take that amount and that gets transferred to cost of goods sold on the income statement. So that's the end of basically a description of the physical flows of inventories through raw materials, through work in process, and through finished goods. Okay, now we're going to do this utilizing the same process, but we're not using debits and credits. We're just going to try value flow. So we're going to start out with number one, we're assuming the beginning balances, and let me change the color here. The beginning balances of raw materials, work in process, and finished goods are all zero. So I'm going to use 0 right here. Now unfortunately, again, I'm using my mouse to draw these characters, so they're not going to always come out very pretty. But I do say the beginning balances of raw materials, work in process, and finished goods are 0. So I've created those. Now, entry B says I purchased $500 worth of raw materials. Now I'm assuming the purchase was in cash, but that's not really important right now to the inventory movement. So what I'm going to do is I'm going to add $500, that's a 5, doesn't necessarily look like a very good one. I'm going to add $500 into my raw materials inventory. Also then, in that same period, I transferred all of the raw materials into work in process. So what that means is I said all of the materials. That means the whole value, the $500, transfers from raw materials into my work in process. Now what you can also see, if I had a beginning inventory of 0, I added 500, I subtracted 500, at the end of the period I'm going to have an ending inventory balance of 0. But what you see right here is that I have moved my raw materials inventory into work in process right here. Okay, now with that then, I'm going to change the color a little just to make it a little bit easier to see. I transferred, or then, okay, I paid then $1,500 in cash for direct labor. So again, when I pay for direct labor, that is going to go into my production cost under work in process. So I paid $1,500 for direct labor. So I'm going to put in the $1,500. And I paid for converting, okay, yeah, I paid $1,500 in cash for direct labor for converting the raw materials into finished goods. And I also paid $2,000 of indirect cost. And this also, by the way, you're going to see it referred to also as factory overhead. But I paid $2,000 of indirect costs supporting the conversion of the raw materials into basically a finished product. So I'm going to write down here an additional $2,000. So now you can see I have all my inputs, $500 worth of raw materials, $1,500 worth of direct labor, and $2,000 worth of indirect cost. And of course, if we add those items up, they will come out to, right now, just as a temporary calculation, that'll come out to $4,000 in inputs. Okay, now what we're told is we transferred all of the products in work in process, that those $4,000 worth of work in process, we transferred them from work in process to finished goods. So we're transferring everything. So we're going to transfer out the $4,000 of the cost, and that'll be transferred into finished goods inventory, $4,000. And again, we can see that the $4,000 transferred out transfers into the work in process. Now again, if you take a look at the calculations, 0 plus my inputs of 4,000 minus my outputs of 4,000 equals ending inventory of 0. Okay, now I have, like you can see here, as I have $4,000 of goods in inventory. Now it says sold all of the finished goods for $10,000. So I sold everything for $10,000. Okay, the first thing you don't want to mistake by putting in $10,000 here, because the only amount that gets transferred from finished goods inventory is the cost of the product itself. So if we sold all of the finished goods, that means we had $4,000 worth of finished goods. So that means we're taking out those $4,000 worth of finished goods, which would be all of our finished goods, $4,000, and we're going to transfer that to the income statement of cost of goods sold for $4,000. And again, if I draw my line, I draw it from here down to here. And again, if you take a look, I start out with beginning inventory of 0, add $4,000 to my finished goods, subtract or output of $4,000, and that equals 0 again. I have 0 left in my ending inventory. Now I can also insert, I sold my items for $10,000, so I'm going to put the $10,000 in my income statement, which means my gross margin would be a total of $6,000. So now you can see in general how we record the numbers. Now what we're going to do is we're going to take this a step further, and we're going to utilize, instead of just simply numbers here, we're going to utilize the T accounts for the exact same transaction. Okay, so now we have T accounts here. And again, I'm going to have to be careful on how I make these because I don't have a lot of room, but I'll give it a try. Okay, we said the beginning balances of raw materials, inventory, work in process, and finishing goods are all zero. So I'm just going to leave those blank. Just assume there's zero up there because I may need some additional space here. Zero raw materials, zero in work in process, zero in finished goods. Okay, I purchased $500 worth of raw materials in cash. Let me cross out A first because we're done with that. Okay, B. So we purchased $500 in cash of raw materials. The debit would be to raw materials for $500 and the credit would be to cash for $500. So now I'm doing my double entry bookkeeping on each of these accounts. Then I transferred all of the raw materials into work in process. So I'm going to use a different color to differentiate this. I transferred all of the raw materials into work in process, and I'm going to do that by debiting work in process for $500, and I'm going to credit raw materials for $500, which represents a transfer out, $500. Okay, then I paid $1,500 in cash for direct labor in converting those raw materials into a finished product. So I'm going to debit work in process for $1,500, and I'm going to credit the $1,500 of cash that I paid. So we see my debit and credit here. Okay, the next item then is I have, I paid $2,000 in indirect costs, and those indirect costs were also incurred in cash. So I'm going to debit my work in process for $2,000, and I'm going to credit my cash for $2,000, which represents the amount of cash I paid for those indirect costs. And remember, many times it's also referred to as factory overhead. So now I have the cost of the indirect costs for converting my materials into a finished good. Now the next item then is I have to, I'm going to transfer all the items, all of my inventory out of work in process to finished goods because I completed everything in work in process. So I know if I add these debits up, there's $4,000 worth of debits, in other words, $4,000 worth of value. So I'm going to credit work in process for $4,000, and I'm going to debit finished goods for $4,000. So now I've transferred the work in process into finished goods. That's this item right here. And now the last item, let's see if I can come up with a little bit better color. Okay, another color. Now what happens is with G, I sold all the finished products for $10,000 in cash. Now again, remember, when I'm transferring my finished good cost to cost of goods sold, it's only at its cost. So I'm going to transfer $4,000 of finished goods out of finished goods and debit them to cost of goods sold for $4,000. And that would be the entry for that. But then I also have to have the sales entry. And with the sales entry then, that would be okay, I sold those finished items for $10,000 in cash. So I'm going to debit cash for $10,000. And I'm going to credit sales for $10,000. And again, you can see the income statement has sales of $10,000, cost of sales of $4,000, giving me my gross margin of $6,000. You can also see my raw materials account comes out to zero. My work in process account, when you add the debits and credit, comes out to zero. And my finished goods account also, when you add up the debits and credit, come out to zero. So that's a debit a credit T account illustration of this same problem. Okay, now we're going to do an exercise regarding the flow of inventory costs where we kind of bring together all of this information. And the first thing we have here is, or I shouldn't say the first thing, but it says Swiss Lodge manufactures chocolate making machines, and during the year the company purchased $2,150,000 of direct materials, in other words, raw materials, and they took and placed $1,800,000 worth of these direct materials into production. Swiss's beginning balance in raw materials, the account in the beginning balance was $350,000 before anything happened. The company also had beginning balances in work in process of $1 million, and I repeat this accidentally, but I shouldn't have. I should have just said, should have left out the and raw materials, because that's just a repeat of what we just had up above. Now the question is, what is the value of the ending raw materials inventory? And then that's A. Then number B is record the material purchases and inventory transfer transactions in the T accounts. Okay, now we have to start off again is to remember it's asking what is the value of our ending raw materials inventory. The first thing we have to remember is, and again, given that we don't have this guideline right here, that we'd have to kind of do this from scratch. What we want to create is our inventory equation: beginning inventory plus materials or inputs, materials we purchase, minus our outputs, or in this case the value of raw materials transferred to work in process, equals ending inventory. Once you have this formula set up, it's going to be a lot easier. Again, we're told that the company had a beginning balance in its raw materials account of $350,000. Now what I'm going to do is I'm going to reduce the amount of zeros. I'm going to leave off the zeros. So $350,000. During the year, we purchased $2,150,000. So now we add in materials purchased, $2,150,000. We're also told that during the year we used $1,800,000 worth. So I'm going to put in the amount that we used, $1,800,000. Now we have a really easy equation. Beginning inventory plus materials purchased, that equals $2,500,000, minus the $1,800,000 means our ending inventory is equal to, or should be equal to, I believe, $700,000. Okay, now let's try the entries in the T accounts here. And again, we may have to work on expanding these a little, just because again the size and the mouse drawing that I do. Okay, the first thing is we're told we had a $350,000 beginning balance. That's in there. We're also told we have a $1 million work in process balance, and that shows there in the beginning balance of the T accounts. Okay, so during the year the company purchased $2,150,000 worth of materials, and so what we're going to do is we're going to debit the materials for $2,150,000. Okay, now what I'm assuming now is that also we paid that in cash. So I'm going to put down the $2 million credit to $150,000 right here. Normally I would have that written down, $2,150,000. Okay, during the year we placed $1,800,000 worth of those materials into production. So that would be, if I'm putting those into production, that would be a debit to work in process of $1,800,000. And the credit would go to raw materials in million of $1,800,000. So now, if you added up the raw materials in terms of debits and credits, this would be $2,500,000 debits, $1,800,000 credits. So that means our raw material balance would be indeed $700,000. And our work in process at this point would be $2,800,000. Okay, so right now we've done all the T accounts, and we've also done the inventory for requirement B and the inventory reconciliation for requirement A. Okay, now with this information going forward, let's take a look at the next page. Okay, I've changed the presentation on this screen a little bit to make it a little bit easier to read. Okay, first thing we're told on this second screen is, as noted on the previous page, Swiss Lodge had a beginning work in process balance of $1 million and transferred 1,000,008 of raw materials into work in process. Now, during the production process, the company incurred $2 million of direct labor cost and $1,500,000 of indirect inventory cost, or indirect cost meaning factory overhead, same thing. Production valued at $5,300,000 was completed and transferred from work in process and moved to finished goods. The company also incurred $2.5 million of S&A, selling and administrative costs during the period. Now again, what is the value of the ending work in process inventory? So again, in order to do this type of calculation, we have to remember our inventory formula: beginning inventory plus inputs, which in our material transferred in from raw materials, and our costs of production, those are our inputs, minus the value that was transferred out from work in process to finished goods, those are our outputs, equals ending inventory. So let's go ahead and find the value of beginning inventory first, and that's pretty easy to find because it says we had a beginning work in process balance of $1 million. So we're going to add that in to the best that I can using the mouse. Okay, we have already, the materials transferred in from raw materials have been added. I could have simply pulled it from here, but we just simply, I simply included it in on this example. So it's from here, $1,800,000. Now we want to add the cost of production. In other words, the direct labor and the overhead, or if you will, the indirect costs associated with converting those raw materials into finished goods. So the company incurred $2 million of direct labor costs during the month. So I'm going to take $2 million as part of direct labor. And then I'm also going to, we incurred $1,500,000 of indirect cost during the month. So I'm going to add in the indirect costs. So now we have our inputs. Now we have to subtract out the outputs, and here it says production valued at $5,300,000 was completed in work in process and then transferred to finished goods. So in this case, we're going to take out a value of $5,300,000. So now if we do the math, $1 million plus 1.8, 2,000,008 plus 2,000,000, 4,000,008 plus 1.5 million is 6,000,003. Those are our total inputs minus our outputs of 5,000,003 gives us an ending inventory of $1 million. So that would be the value in requirement A. Ending inventory would be equal to $1 million. Now, what I've done here is, if you take a look at the gray items, these are basically entries from our previous exercise on the previous slide. So these are entries that have already been made. Now what we're going to do is, we're being asked for requirement B, record the journal entries for the production transactions that we see here in the T accounts. So what we're going to see here is that we see our beginning inventory was already included in work in process. Materials transferred in from raw materials of $1,800,000. That was already included, the $1,800,000. Now direct labor, $2 million, okay, and then we're assuming that's paid in cash. So $2 million to work in process for the cost of the labor converting our materials into finished goods, and the credit would be to $2 million in cash. Then we have $1,500,000 of overhead costs associated with converting the raw materials into finished goods. So we see work in process $1,500,000 and our cash equal to $1,500,000. Also, we're told that $5,300,000 value of work in process was transferred from work in process to finished goods, and we can see the journal entry right here: the credit for $5,300,000 to finished goods, and the debit to $5,300,000 to work in process, and the debit to $5,300,000 to finished goods. So again, if we take a look at the accounts here, if I take a look at my work in process account now, I would see I have $1 million more of debits than I do of credits. And what that means is my ending balance was $1 million. My ending balance per my work in process was $1 million. Okay, let's go on to the final slide. Now we talk about finished goods. Swiss Lodge had a beginning inventory of $500,000 of finished goods during the year. The company had $5 million in cash sales and a gross profit margin of 60%. So it goes back, what is the value the inventory transferred to cost of goods sold and the ending inventory for finished goods? And again, in order to do that, we have to remember the inventory formula. Beginning inventory plus inputs minus outputs equals our ending inventory. Also down here, all the items that are listed in gray are previous journal entries, just to bring our calculations here up to date. So we're going to start out with, in finished goods, we were told we had a beginning inventory equal to $500,000. Okay. We also know that the amount of materials transferred from work in process, we know that was 5.3 million from our previous slide, and also up here too, the 5.3 million. So we know 5.3 million, so that's posted there already. Now the question is, we're not told what the value of goods sold is, and this is where it becomes just a little bit more complex. It says that we had $5 million in cash sales with a gross profit margin of 60%. So now this is going to require a calculation to determine what was the value of our goods sold. So let's go ahead and go down here so where we have a little bit more room. We had $5 million worth of sales. We're told that our gross profit margin was 60%. Now, if you remember, our gross profit margin is the percentage of profit that is left over after you paid for your cost of goods sold. So what we see here is it basically is saying sales minus cost of goods sold equals your gross margin. So if we use this formula here, now let me erase this $5 million here for a second. Or better yet, I'm not going to erase that. I'm just going to put down, I'm going to do it over here. Sales, again, minus cost of goods sold equals your gross margin. Okay, I know my sales are equal to $5 million, so I'm going to put that down right there, $5 million. Now I'm told my gross margin is 60%, which means my gross margin as a percentage of sales would mean it would be 60% of sales. Or in effect, my gross margin would be $3 million, which is 60% of my sales of $5 million. So if I know my gross margin is 3 million, my sales are 5 million, my cost of goods sold by simple extrapolation would have to be $2 million. So that's the amount that went to cost of goods sold. In other words, the value that was moved out of inventory and into cost of goods sold. So the value of cost of goods sold, basically, in other words, the amount that's moved out of the finished goods inventory would be equal to $2 million. So we have $500,000 plus 5,000,003, so that's $5,800,000 minus 2,000,000. That would leave us an ending inventory $3,800,000. And again, if I were to create the journal entry in this case with finished goods, I would credit finished goods for the $2 million and I would debit cost of goods sold for 2 million. And my total sales would be, again, the sales were had $5 million in cash sales, so my debit would be to cash sales. I would debit cash for $5 million and I would credit sales for $5 million. And with that, that is the solution to problem number 16.